Now, you mentioned that this crisis was a unique one in nature. It's also a unique one because it was purely an economic crisis and not a financial crisis. For once, we're not seeing banks or financial intermediaries come under pressure. Are there any signs looking ahead to 2021 that that might change?
Well, first of all, I think it's very important what you said, and very much in contrast to what happened during the great financial crisis. Um, Banks on this occasion were a source of strength, as policymakers like to say they were part of the solution, as opposed to being part of the problem. And that was largely as a result of what policymakers have done since the great financial crisis, in particular, the international financial reforms, Basel III, and so on. Now, that has allowed the supervisors and the regulators to use all the flexibility at their disposal to get banks to continue providing credit to the economy. Going forward, the question is how the crisis will, or the general evolution of the virus will be, and therefore the possible impact on the banking sector. All the work that has been done so far, the stress test carried out by the authorities suggests that the banking system is still in a good position, in a strong position. Of course, very much will depend then on the specifics of the evolution of the crisis, given that we're moving from a liquidity to a solvency phase, and therefore we can expect more bankruptcies going forward, bankruptcies in the corporate sector.
Right. So to pick up on that, one other thing that came out of the report is you note that credit lending standards are actually beginning to tighten from the banking perspective. Do you think that banks here are just being cautious, or is this a premonition of what might happen next year in the sense that we may start to see a pickup in bankruptcies and solvencies, as you mentioned, and that banks are really beginning to provision for that outcome?
It's very important for banks to remain cautious, to assess credit risk and price credit risk appropriately. And indeed, that is also what the supervisors are asking banks to do. They're asking them to make sure that the pricing of their loans is appropriate. They're asking to make sure that they're taking the right amount of provisions. They are asking them to make sure that recognize all the non-performing loans. And this is indeed critical in order to ensure that they will be able to withstand any possible losses going forward in the best possible way.
Now, also in your reports, you talk about there being daylight between asset price valuations and the economic prospects. And you say that that is something that has been present for a while, but appears to persist. What do you point that down to? Why is there such a wedge between what financial markets are telling us versus what's actually happening on the ground?
Well, it's always very difficult to assess these situations accurately because there is great uncertainty about how the future will unfold. But clearly, in the markets or the valuations of risky asset prices responded in the right direction to the news of a vaccine and also to the changes in the political environment that have taken place, in particular the US elections. So they responded in the right direction in the aggregate, and they responded in the right direction in terms of gainers and losers, which is very much what one would have expected. Having said that, they already started, if you recall what we discussed in the September issue of the quarterly review, they already started from a situation in which there were concerns about daylight. And moreover, those concerns about daylight were already present before the pandemic. And now markets, particularly risky evaluations of risky asset prices, are roughly in line with, and if not higher than where they were pre-pandemic. So as a result of that, I think that there are legitimate questions about how far the markets may be overstretched. When it comes to the reasons, well, exactly what the same reasons that have applied now for quite some time. On the one hand, markets are more optimistic than many policymakers or forecasters, professional forecasters are about the future. On the other hand, the policy support has been extremely important, not least the monetary policy support, which has meant that interest rates in particular have been very, very low. We emphasize that in the annual economic report, and that has provided some fuel for the search for yield that we're seeing now prevailing in the markets.
Do you think there's a risk that central banks have actually been too interventionist and that they've encouraged this type of behavior, this yield-seeking behavior, even investing into asset classes that don't necessarily warrant the valuations that are being reflected right now?
First of all, it was very important, as I mentioned at the beginning, for central banks to come in the way they did. It's still also the case that the economy requires quite a lot of support. Now, there is always a trade-off and a delicate balance to be struck here. On the one hand, you have to provide the necessary support for the economy. On the other hand, you have also to watch the possible side effects of that. And clearly, one side effect is a search for yield. Now, there is always a delicate or fine line between appropriate risk-taking and excessive risk-taking, and central banks are fully aware of that, and this is a kind of trade-off, a balance that they have to manage the best that they can.